Welcome to Elevate Market Chat. This episode was recorded November 20th following the reporting of NVIDIA's earnings. Shane and I start by checking in on the broader markets before talking about NVIDIA, market sentiment, and what other recent conversations are telling us about the state of the markets. Thanks for tuning in. Shane, how's it going?
Kyle, my man, I'm good. How are you doing today?
Doing good. Just have a bit of an overcast day, and I saw you were out golfing and just wondered how that could be. But then again, I remember that you live in Florida, which is certainly a long ways from me, and the weather can be vastly different.
Vastly, yeah. It's sunny and 81 degrees here today, and it was a nice morning to sneak in a quick 9 holes and then get my butt back to the office before the market even opened. So that was a beautiful thing.
Nice. Well, it's good to have you back and here to do this recording, which we are doing this on November 20th and middle of the day, so about noon here in Colorado. And we have a bit of, shortened trading days on the horizon. So Thanksgiving is next week and then Christmas after that. And, Christmas, maybe it came early for some or not, but NVIDIA, that's been a big one in the market and they just reported last night. So definitely want to get to that. I know that you've been watching that price action and you've got some thoughts there. So love to hear what you think. But, for starters, just thought I'd give a quick recap kind of where the market is. And right now, the S&P, so up 13% year to date, the NASDAQ up 20, the Dow 11, and then gold has been the leader this year. So gold is sitting up almost 67%. So heck of a year there. But the big one here is I got to be honest. Last night I watched the market after Nvidia reported and thought, here we go again. Just bullish price action and prices going higher. So we're just gonna have a heck of a year. But you went golfing, and I don't know if it was that or something else, but I'm not seeing green on my screen anymore, and it looks like things turned around a bit. So curious if you had some thoughts to start with there.
Yeah, not much green on the screen anymore. NVIDIA reported amazing growth yet again. Some of the best numbers in the history of the free world that they've been putting up for quarter after quarter after quarter, and it's just not enough. I mean, my initial thought is like, who is buying this stock? Who has money left and doesn't already own enough NVIDIA that they have to buy some? I can't understand that. I mean, if you bought NVIDIA anytime, over the past, I guess, couple years, like you're probably up a lot. So if you started at, say, a 5% allocation in your account and it doubled, well, now you got 10% of your money in NVIDIA. I mean, not accounting for the fact that your overall account has grown, but point is you have a lot more NVIDIA than you started out with without having to buy any, right? Um, so if you're putting new money into your account, the idea that you should be buying more and more and more of the same stock, like I don't think that's what most people are doing. Sure, some of them are. I'm sure there are people with 100% of their account in NVIDIA. But I look around and I'm like, certainly from a professional standpoint, like who doesn't own the stock? Like who's underweight NVIDIA? And I don't know. I mean, arguably, I guess we could own a little bit more, but I'm not going to chase it higher at these prices. And, if you look at people, if you say NVIDIA, people think the stock's probably up, hundreds of percent over pretty much any term. And, as of right now, where it's trading as we're talking, it is actually down 1.5% from where it traded on August 12th. And it's November 20th. So we're talking 4 months, two earnings reports, and the stock's down 1.5%. So what does that tell you? I mean, it tells me a lot of things, but as we talked about, I think on the last call, like there are other stocks out there that are growing rapidly and I guess maybe more fairly priced.
hmm
So
And I think it's important to point out if you just look at price, NVIDIA right now it's trading on my screen at just under $185 a share. But if you look at the valuation, so what does the company have in terms of if you wanted to, buy that company, or just what is their net worth essentially? They just crossed 5 trillion. So if you buy it here and you're trying to double your price, what you're effectively saying is that you think Nvidia is going to be worth 10 trillion. Have you ever heard of such a number?
No, I mean it's the only $5 trillion company on the planet. I'm not trying to defend the price of Nvidia, but just to take, to take another side of it, just to push back a little bit on what you just said, because I think it's fascinating, right? I'm not here to dog Nvidia. It's a great business, the greatest ever. I've nothing bad to say about it. Um, but the valuation's crazy. That said, the valuation is not as crazy as it was before AI was even a thing. So get this, man. I mean, it wasn't 5 trillion back then, but on a price to sales basis, this thing was over 25 times next year's sales back in November of 2021 before the Chat GPT came out. And it was at the same time, it was trading at 65 times next year's earnings. Today, it only trades at 27 times next year's earnings, which is actually not crazy. Um, and so anyway, I'm not saying everybody should rush out and buy Nvidia. I'm confident that if you're patient, you will get to buy it at a cheaper price. But the truth is this company is just growing rapidly, and it's just printing cash. It's amazing what it's able to do. It's well above my target price. I think, I'd be willing to pay, and we did this back in April. We paid 10 times forward sales for Nvidia. Um, there are, I don't know, I could count on one hand maybe the number of the companies that I would pay 10 times forward sales for. Like I think that's a fair price. Not very many of them in the whole world. Nvidia is one. Um, and I think you'll get the chance to buy it at 10 times forward sales. Right now, it trades at 15.67 times forward sales. So, I mean, to get just simple math, right? To get to 10 times forward sales, it's got to fall about 30% from where it's trading right now,
Hmm.
which is like a layup. I mean, Nvidia was down 60% or something in 2022, and it's been down 30%, I don't know, several times in the past couple of years. I mean, at this year when it bottomed at $86.62 in April, it was down 43% for the year from its January highs. So like Nvidia dropping 30%, it's like not it's no big deal. In fact, it's already down from its recent high. It's already down 14 almost, yeah, 14% from where it traded on October 29th. So in the past 20 days, it's down 14.36%. So I don't know. This thing could be down 30% by, time we're off this phone call. I don't think it will, but it could be. And for what it's worth, just to take all that one step further, the market's up. What do you say, 13% year to date coming into today, and the S&P 500's down what one, only like a 0.5% now, bounced a little bit. Um, the market could finish the year down. That's an unpopular opinion, but it absolutely could. Like we could get to December 31st, and the market is not up for the year.
Yep.
That's
And
an unpopular opinion. And I'm not saying that's what I think will happen or that will happen. I'm just saying if it did happen, nobody should be surprised.
yeah, and I think that's a good point to bring up because just look back at April. We're not forecasting here, but it's good to be aware of what risks are out there. Is that the market pulled back almost 20%, and it surely didn't take very long. So
Right.
that's the thing is, when it comes to selling, the market certainly can move pretty quick.
Yeah. And I'll tell you, I mean, just based on inbound, activity from our clients, and people getting impatient and frustrated with not being up enough because they're in too high quality of stocks, and all of the garbage stocks are the ones that are doing the best and the most expensive. We're looking for high quality companies trading at a fair price, and we're planning to hold them forever. So like our returns that we're focused on creating long-term returns for people. And a lot of times people get laser focused on the short term, like what's happened over the past 3 months or what's happened over the past 6 months, right? Since April is what people are looking at. And they're saying, like, gosh, I should be up more. And it's like, I'm focused on making sure that you don't have any major catastrophes that interrupt your retirement over the next 5 to 10 years. I'm not looking at 6 months. I'm trying to buy high quality businesses that have a lot less volatility overall. I mean, not for all of our clients. We get into speculations and all that for some of our more aggressive folks. But by and large, our clients hire us to make an adequate return when the markets are up, but not to lose a ton of money when the markets get smoked, which they do from time to time. So, that's what most of our clients hire us for when they originally hire us. And it's amazing to me how often and how many of these people just kind of forget about that when CNBC and Bloomberg and whoever else is out there in the mainstream media will only talk about such and such stock was up 200% yesterday and they have no earnings. And they don't come back to it when that stock drops 50% back to where it started. They only report on the ones that are like up big. And I don't know, I think it causes people to become impatient and take their eye off the ball. I actually heard a new term this morning that describes this. It's called portfolio abandonment, where people just abandon their entire portfolio process that we designed for them to grow their pile over the next 5 to 10 years, and they do it on a short term evaluation period versus a benchmark that's like 40% in 10 stocks. It's I don't know. I've never seen that work out well. Obviously, I wrote a whole long commentary about that, just over and over and over throughout my career. When I start to hear this from, first it's one or two clients, then it's three or four clients, then it's 5 or 10 clients, and I'm just like, okay, we're close to some type of short-term peak, and you know, I don't know if that's really starting, now today, but even if you just look at the S&P 500 since October 29th, so call it for the month of November so far, we are now down 5%. That's the first 5% drop we've seen since April. And people will call me and be like, well, why did you get so much more aggressive? And it's like, oh man, I didn't, I only did what people asked me to do. But there were plenty of people who asked us in October to get more aggressive because the market was, just going up and up and up every day. And so there comes a time where it's like, okay, I have to, it's your money. I got to do what you're asking me to do. And, it's unfortunate that we'll probably hear from some of those people and they will be upset with us for well, having done what they asked us to.
Hmm.
So yeah, it's a tough topic to really discuss because everybody isn't guilty of that, and I don't fault people for having emotions. I mean, God made us with emotions for a reason. They're a good thing, but I think we have to understand when we're making like emotions and investment decisions don't mix well.
I would certainly agree with that statement. And I'm curious, you mentioned this, you having conversations with clients and they start to go towards, I want to get more aggressive and be in there more. And that's one view on what we call market sentiment. So, what does the market think and how are people feeling? How do you approach that process to kind of get to understand what are the masses thinking or feeling about where they are in the market today?
It's a good question. I mean, thankfully we have a lot of clients, so I have some proprietary indicators of just like from people and seeing some of the inbound activity and questions that we receive from clients. Um, and everybody's got like well, I shouldn't say everybody, but a lot of people have a mother-in-law. So it's often called the mother-in-law indicator. Not that I have anything against there's in law. Um, But when your mother-in-law starts asking you about the stock market, then something's up. Because by the time it gets to the average mother-in-law who's not watching CNBC or Bloomberg, right? They're getting their news from somewhere else. But by the time that they're talking about a stock or about the market, then you know that there's something going on sentiment-wise. I mean, there's all types of other sentiment reports, right? I follow the University of Michigan surveys, and I check in on the CNN Fear and Greed Index every now and then, even though I did write about that in the commentary. That they say that the market, maybe the market just predicted this fall for the first time. It wasn't a contrarian indicator because there was extreme fear in the market just before it began to fall a whole bunch. Usually, that's a contrary indicator. If there's extreme fear on the fear and greed thing, then you would normally want to bet that the market goes up. So I don't know how CNN's really calculating it. I can't recreate what they claim they're using and come up with the same results. And I guess, as I mentioned in the commentary, the only fear I see leading up to the end of October is the fear of missing out and people who are absolutely, I know them, have known them for a decade or more. I know them to be conservative investors, conservative and patient people. Um, we're making decisions to get more aggressive, right up into the most recent market peak. And so, a 5% drop is really no big deal. I'm not saying like, oh, it's the end of the world, the sky is falling, market's down 5%. Like, that's totally normal. We were way overdue for a 5% drop. But the funny thing is if I call all of our clients today and say, hey, market's down 5%. I know you've been, wanting to get more aggressive. Now would be a better time you know, than 3 weeks ago. They'll be like, "Oh no, market's down 5%. I don't want to do that right now. I'm not too aggressive anymore. I was aggressive 3 weeks ago and the market just went up and up and up every day. But now that it's selling at a better price, I don't want to buy that." It's a very strange thing, the stock market, right? And
Mhm.
I don't know, man. I mean, it's obvious to me, and I've heard the analogy so many times that I hesitate to bring it up, but maybe there's somebody out there listening who doesn't think of it this way. But it's just the only situation in humanity where people don't want to buy something at a better price. They'd much rather, like, when things go on sale at the mall or at the grocery store, you're like, cool, I'll get a better price. Let me buy a little extra. Market does the same thing, and people have the exact opposite reaction. They're like, oh no, I can't buy that. It's cheaper. I'd much rather pay 110 for this thing than 100. I don't understand it, um, but that's the way it is. So
Yeah.
that's where, I mean, that's where the market is inefficient, and people who are paying attention and doing analysis can generate an edge and perform over long periods of time. Can't always outperform over a short period of time, but over long periods of time, you do the right thing enough, and those good decisions compound. And 5, 10 years down the road, compounding is the eighth wonder of the world, right? You want to compound your capital at high rates by buying companies that compound their capital at high rates and then doing basically nothing. That's
Hmm.
that's even what Warren Buffett said. I'm actually rereading Snowball, the biography about Warren Buffett, and it was a great quote in there last night. I don't have the book in front of me, so I can't say it verbatim, but he's like, look, this is the way to make money in markets. You find a business that can compound or grow its capital at 20% a year, and when it makes that 20%, right? Say it's $100 million business, it makes 20 million. It reinvests that 20 million at uh and compounds that at another 20%. So now it's 144 million, and it just keeps doing that, right? You don't want it to pay out dividends. You just want it to keep reinvesting its own capital and compounding its own capital at a high rate, and let that compounding machine just do its business and don't touch it. Regardless of what the market wants to buy or sell it for is totally irrelevant. You have a money compounding machine. What you want to do is stay out of its way.
That is very true. And it's funny, I just heard somebody, had a nuance on your earlier statement, but stocks are the one thing when they go on sale, everyone runs out of the store.
Yeah.
Um, but I've had conversations, it's this mix of them, from, hey, I made this big return last year and I expect it to continue. And I'm talking, 20%. So that's always an interesting one. I've also had the world's ending kind of thing, but I guess what I look at a little bit is the VIX. So that's one where essentially what are the big money managers paying for protection on the downside? And it's inched up, but inconclusive at this point. I think the bigger one is, again, we talk about this a lot, but just the positioning, getting ready. I know if we look at the underlying things that may impact something, some of those is we have had this government shutdown that on the economic side could have some impact. Shane, one thing I wanted to get your thoughts on is emerging markets. So that's one we've certainly seen some pretty positive momentum this year in the emerging markets. And then I couldn't help but notice the other day the Japanese 30 year just hit a record high interest rate. So have you kind of had your eye on those or have a pulse on what might be going on there?
Yes and no. I have seen the Japanese interest rate deal sort of making its rounds, and I did a little bit of homework on it to just kind of see, what was what, but ultimately there's I don't know where I got this from. There was a post somewhere that Japan had triggered the biggest shift in global finance, and almost nobody is talking about it. But all I hear is people talking about Japan suddenly, which is normally like not on the menu. But Japan's 10-year yield recently just hit 1.73%, the highest since 2008. And at those levels, Japan pays an extra $27 billion in interest every year compared to what they have been paying. Pensions are pulling trillions of dollars out of U.S. treasuries because hedging, with having to repatriate dollars into yen, makes American debt unprofitable, right? Once they can reconvert or reconstitute the currency back into their own currency. And the unwind of what's called the yen carry trade um, puts over $1.2 trillion of leveraged global bets at risk. And so this is really the point, is when the largest buyer of anything suddenly becomes a seller, right? Things tend to change. And in the U.S. yield market, when the largest buyer of U.S. bonds, the largest foreign buyer of U.S. bonds, suddenly becomes a seller of U.S. foreign bonds, the interest rates don't just kind of gradually drift higher; they gap higher. Like they just overnight higher interest rates to attract new buyers. So it could be a major issue. I think a lot of what people are kind of I don't know. It seems like they're trying to make a very big deal out of this, but what I think actually happens is that this stuff plays out over the course of like more time. I don't really think that it will be an overnight type um of thing. Like the recent data actually shows that Japan increased its U.S. Treasury holdings in September of 2025. So that they haven't, maybe the shift has happened since then. Data is a little slow to come out, especially with the government shutdown. And there are signs that, Japan institutional investors are adjusting their portfolios, but I, they're most of like they know that if they do it overnight, they're gonna crush their own portfolios, right? So they have to kind of unwind these trades slowly, or whatever they have left in their investments is going to get crushed. So I don't know. To me it just kind of seems like a distraction from other things. But it's all together, right? The global economy and stock markets are a very, very, very complex system, and it's often very difficult to tell which thing is going to, you know, kind of prick the balloon, so to speak. That's why they call them black swan events. I don't, yeah, now that everybody's suddenly talking about Japan and saying, "Oh, nobody's talking about Japan," what we know for sure is like that's not going to be a black swan event anymore because everybody now it's on everybody's radar. The black swan event You can only see in the rearview mirror. It's like, holy smokes, that was scary. So I don't know what that event will be, or when the next black swan will show up. Um, but at the end of the day, I do think, if nothing else, I think that the situation with Japan's interest rates rising, meaning that they can get better interest rates just lending to their own government instead of having to do it in the U.S., means that um, higher rates in the United States are more likely than if that hadn't shifted. And that means, mortgage rates stay higher, auto loan rates stay higher, the US 10-year stays higher, regardless of what the Fed is planning to do with the short-term rates. So we've talked about that many times on this call, is that the Fed doesn't set the 10-year, the 30-year rate. Those are influenced by supply and demand. And if there's less demand for those, then the interest rates will go up to attract more demand. That's just how it works.
Hmm. And I think it brings up one important point is that everything happens really slowly and then all at once. And when you hear these developments and the change in the rates and everything, we might not see the impact of this for, I mean, it could be 5, 10 years or more. And that's the challenge is that when you look at the economics and just some of the larger market moves, they don't happen in a short time frame. And I think, one thing I do is journal. And what's so important about that is that when you go back 2 years ago and look at the notes about, well, what was I seeing in the markets and what was going on, is at the time it felt like everything was going to happen right away. And then you look back and only 2 years have passed and the perception of time and how slow it actually all moved is kind of astonishing. It's just the market moves in big cycles. And I think one number is, I think the S&P, it goes in, I think it's 17-year cycles. I don't know if you've ever heard that, but there's certainly big machine parts moving and they take a lot of time to go through. So hard to kind of take these little bits that are coming out, starting to hit headlines and think that it's an immediate impact anywhere.
Yeah, that's the old Ernest Hemingway quote. How did you go bankrupt? Gradually, then suddenly. That is the answer. And by the way, I did find that quote from the Snowball. It's a Warren Buffett was asked at his shareholder meeting. I don't remember which one this was, years ago, but he said he was asked, "What is the ideal business?" A shareholder asked when the questions began, and Warren said, "The ideal business is the one that earns a very high returns on capital, and that keeps using lots of capital at those high returns. That becomes a compounding machine." So if you had your choice, if you could put $100 million into a business that earns 20% on that capital, 20 million, ideally it would be able to earn 20% on 120 million the following year and on 144 million the following year and so on. You could keep redeploying capital at those same returns over time, but there are very, very, very few businesses like that. We can move that money around from those businesses to buy more businesses. And this is about as clear a lesson on business and investing that Warren Buffett would ever give. Um, you know what strikes me about that is that he doesn't say a word about the price. Over those years of compounding, the capital means the earnings of the business, the profits of the business. The share price will fluctuate up and down every day, you know, but the value of the business and what the business does and the amount of return that it generates for its long-term owners, it just improves. It's a one-way train, right? It just goes up and compounds and compounds and compounds. But the market, just based on sentiment or whatever's happening in the indexes or the benchmarks or whatever, might sell you that business at $100 one day and $95 the next day and $130 the next day. And it makes absolutely no sense. And guys like Warren Buffett don't really care about that. I mean, they care in so much as when it trades at a fair price, they'll buy more of it. And when it trades at a high price, they won't buy more of it. But they're not they're not looking to, sell and trade around and say like, oh, this business is obviously worth less because the price has gone down in the market. They really don't care about stuff like that. And they certainly don't look at, 3 months worth of price data in order to decide whether or not they still want to own a world-class business like that. And that's what we try to own at Elevate, is just super high quality businesses that have a very, very high return on invested capital or return on equity. There are other measures that we use as well, but those are two very, like, return on invested capital is one of the best ways to just very quickly ascertain whether a business in any industry is better than average and better than another business. It's a great equalizer because it takes into account all equity and bond capital.
And I think what I hear you describing is what we often talk about as a capital efficient business.
Yep.
Is that right? You give it $1 and they'll make $3. So the only thing holding them back is getting more dollars.
Yep.
So, and I think that is something you and we both can agree there. Capital efficient businesses, that's where strip away the share price. And if you have those types of businesses and there's not some structural change that derails how quickly they can take money in and, create more wealth with that, those are great companies to own. And that's that long-term view, and where that certainly becomes relevant and something to hold on to.
Yep, that's what we focus on, and just keeping people focused on that is the challenge.
Absolutely. So, well, Shane, I know we're kind of getting to the end of our time here. We've got Thanksgiving next week and some upcoming holidays, but as always, I appreciate your time and thoughts on this. And yeah, you enjoy the rest of your day.
All right, man. You do the same. Thanks, Kyle.
Yep. Bye.
Special thanks to our audio engineer, Stephen Crowley, for mixing this episode. This podcast expresses the views of Shane and I as the date indicated and are subject to change without notice. Elevate Capital Advisors has no duty or obligation to update information included. All information is for educational purposes only. Certain information concerning economic trends and performance is based on information from sources deemed to be reliable and has not been independently verified for accuracy. Wherever there exists potential for profit, there's also the risk of loss. This podcast may not be copied, reproduced, hosted in whole or in part in any form without prior written consent from Elevate.